IFAs are often trusted with their clients' financial affairs. According to regulation, clients are given advice which ultimately results in an investment objective and goal specific to the investor. But how does an IFA choose an investment product? Is it necessary for an IFA to understand how to combine investment products and how do fees actually work? These are some of the pertinent questions that we'll be asking this evening. But gentlemen, on that note, I welcome you once again to the program. Kubi, I'd actually like to start off with you. What is the difference between independent financial advisors and financial planners?
Let me first start by saying you've got a quant on the desk, you've got an IFA on the desk, and you've got a fundamental analyst. It can only be interesting debate this
Okay, perhaps then I should
evening.
actually then divert that question perhaps to the financial advisor.
Yeah,
or
Lenny,
a financial planner.
I think if we're going to look for a distinction, I think neither of the IFA or what's known as a financial planner have clear distinctions in the market. So I think where we are at the moment is that whether you're a financial planner, a broker, an IFA, and a number of other terms that one goes by, there generally seems to be a mishmash. And I think this is one of the problems that we have in the industry, is we don't have that distinction. So
Okay,
that
why
one
is that?
could
Does
do
it come down to regulation? Does it come down to qualifications? How does one then get those titles?
Well, I mean, when we look at qualifications and more specifically, we then go to experience and things like that. If one joins the Financial Planning Institute, then you'd be looked at as a certified financial planner, provided you've had the necessary qualifications behind you. But then that doesn't stop anybody else calling themselves a financial planner with no experience and no qualifications behind them. And it is a regulatory issue, which I know that certain parties are trying to look at.
And then they sort of act more like a broker than a financial planner in a sense.
Correct. So then they become investment salesmen, essentially.
I mean, I think the FSB has gone to great lengths at the moment. They're going through a drive where they're trying to, where they're forcing exams, which are called registered persons exams. And there's a whole range of these things that registered financial planners and people that are giving advice specifically around financial issues will have to potentially do. The first set of those are predominantly just around the regulation, and then later ones might be around instruments and so forth. And hopefully that'll kind of distinguish between the salesman and people that are actually giving advice at the end of the day. Whereas at the moment, that's kind of a murky field, in a murky kind of area for me, I would say.
Okay, what is also quite interesting, I would assume that if you've got 50 million rand that you'd like to invest, clearly you'd be taking it to a very different fund manager or an independent financial advisor as opposed to a financial planner. And if you've only got around 50,000 rand to invest, does that then change the hierarchy in terms of which kind of people you could access?
Well, I think depending on how much money you got to look at the infrastructure that the planner or the financial advisor has. And some of them, because they deal in or are a bigger business, they've got much better, risk reporting systems. They've got more staff that can do more research. So very much one has to do one's research before one chooses who's going to advise one, depending on how much money one's got.
Okay, so
You see, I mean, the big issue I think in the industry at this stage is that financial advisors or financial planners, so to speak, are in essence paid to set investment objectives and try and understand people's financial scenarios and what could potentially play out for themselves over time. They're not in the role of an asset manager. They don't understand necessarily assets. Many of them have never managed money in all their entire lives. But yet, if a client rocks up, and regardless of the size of that client, the client requires a service. And often that service kind of touches around estate planning, it touches on tax issues, it also touches on the kind of investment structures that you want to utilize, and then potentially how you should be investing your capital. And that's potentially a gap at the moment because you've got the product landscape, which is the investment product landscape. So these are investment products that are run by asset managers. And on the other end of the scale, you've got financial advisors or financial planners who are trying to set objectives for specifically for clients. How do you combine those things? And maybe that's something that Sean should ask.
Exactly. How do you combine those things? And I'm sure when it comes to objectives and setting of objectives, it's really got to do with risk profiles, I would assume.
Well, that is the common assumption, and I think it's still widely used in the industry. And the problem is when it comes to pure risk profiling, when it sits down in front of an investor and says, fill out this one-page form with 6 questions on how you feel today, essentially, and then base your investment objectives on that, you're going to come short somewhere. I mean, that's guaranteed. I think what it often leads to as well is what we call reckless conservatism. So, firstly, a lot of the questions are leading, and a lot of them in times that we're experiencing right now, if you had to put a risk profile in front of somebody today, it would be very, very different to what would have happened when we were experiencing a bull market just a couple of years ago. And I think that's the folly of doing pure risk profiling. So what we do when we have a look at investment objectives, it's rather to sort of sit down and, like Kirby says, bring your entire financial life together, okay? See where the investment fits into it. Then start establishing to say, well, how hard is this money going to have to work for you? And then from there, understand the type of volatility / risks that you're going to be exposed to in order to achieve those returns, and make sure that they're comfortable with that.
And that obviously includes the likes of the more conservative aspects in terms of estate planning,
Sure.
the tax issue
Sure.
that Kirby was
And
alluding
the
to
tax
as well.
issue is a very, very big one when one looks at putting together investment products, because at the end of the day, if you start deciding on where and how and what platforms to use, tax becomes a critical issue in driving sort of really good performance.
How important is offshore investing to your clients, and what kind of expertise do you think the South Africans have in placing money offshore? Do they just go with a fund manager that does it for them, kind of thing?
When looking specific for offshore?
Yeah.
Yeah, see, and again, this is the issue. I think a lot of clients, when looking to go offshore, it's purely an emotional decision. They're either sort of hedging against the rand, or they've got the Zim syndrome. So that's purely what they're basing their investment decisions on, which is not entirely
But what,
the
from
right
a
way to go.
diversification perspective, surely you'd want to have some portion, you know, not tracking emerging markets or not exposed to a commodity cycle or the political risk in South Africa.
From a diversification point of view, absolutely 100% agree. But I think that then fits into the overall investment strategy, is to really understand what are the objectives of this and how much can we then go and look offshore to drive those type of returns
Well,
for
some
you.
would say that if the rand is at the level that it's at now, that it's only wise to take money out of the country. So perhaps, you know, it's a double-edged sword, because you've got the opportunities on a global level that you'd want exposure to. When better to do it than when the rand is looking strong?
Maybe the important thing as well is to understand how the investment objective looks specifically for a client, and then understanding if that actually allows for international or offshore investing, or if it doesn't allow for offshore investing. And I mean, maybe for me as well, is you have to take the human element into consideration. If you're sitting with a client who has been burned in some experience in an emerging market somewhere, maybe across the borders from, you know, of South Africa, and you've got that situation, there's a fear, and his objectives potentially allow for some form of international holdings, maybe that should then be considered in a meaningful way. Otherwise, you might want to do it from a diversification perspective.
Okay.
The bigger question, though, for me is, and again, sorry, let me also just say that once you set an objective for a client, it's not a one-size-fits-all. You might have a high net worth individual whose capital might not want to have to work that hard in order to, you know, assume a specific lifestyle, but it might be worthwhile for that capital to work really, really hard in order to create kind of lifetime assets for kind of generations to come. So it's kind of a two-edged sword, and that's where the planning process kind of fits in quite nicely. Maybe just a question for Sean. I mean, Sean, how do you, in essence, kind of drive the portfolio construction process around a client? You're sitting with a client, how do you decide around product? How do you decide around kind of, how do you combine these things? You know, is it equities, is it bonds, is it cash? I mean, what is it, and how do you actually do that?
I think the first thing for me is when we start looking at investment objectives, we do have financial models that we will take our clients through, which gives the short answer in terms of, firstly, A, do I have enough? And B, how hard does this money have to work for me to make it enough? Once we have that answer, we've got some kind of return target that we want to start achieving. And when we understand the return target, we bring it back to say, well, the most reliable way of driving those returns is ultimately going to be asset allocation.
Yeah.
Okay, then we start looking at the asset allocation. Now, me personally, I don't set those asset allocations. I will then go and outsource to an asset consultant to give me an idea of where are we best suited for the asset allocation on that.
And once you set the objective up front, does it change?
On an annual basis?
Do you rebalance it, perhaps on
Critical.
a 3-year basis, on a
No,
5-year basis?
no.
What do you do? What is the
As
process
far as possible, where you can actually get solutions out there that will continually rebalance for you, that for me is the key component to put in, because rebalancing is very key, and I see it time and time again.
How often do you do this type of rebalancing?
Well, I mean, if you take someone like in the Axis environment, I think the balancing is on virtually a continual basis, right?
Yeah, I mean,
On a quarterly basis.
I mean, I mean, let me just put this kind of into context. I mean, you've got financial advisors and financial planners at the end of the day, and then because they don't necessarily have the skill in order to potentially kind of combine different investment products, like an equity fund, a bond fund, and a property fund, and a cash fund, which they then have to rebalance on a continuous basis, they might, for instance, engage with a service provider, such as a multi-manager or an asset consultant, which Sean spoke about just now. Axis being an example of one of those, where the rebalancing will then happen There might be a specific investment objective that could potentially be married with who the client is at the end of the day. I mean, Sean, am I correct in assuming that most IFAs out there potentially don't have that skill in order to kind of combine investment products? That's not necessarily their skill set.
Absolutely. Absolutely. I think from an asset allocation point of view, that's the first problem. So what you do see is there's this initial upfront. They do a fairly good job at getting the asset allocation right up front, but then it gets left.
Yeah.
And that's it.
And I, as a client, obviously have to trust you because you have now outsourced other managers, so to speak. So you are my point of reference.
Sure.
So if you get it wrong, then the whole thing falls apart. Roland, I know you've got some thoughts in terms of the trends that we're seeing on an international basis, and I'm sure that these trends change dramatically because of the crisis and where we are today, with the risks profiles changing as well.
Yes, absolutely. I mean, asset allocation is going to change now ever more so than last month. But what I think is also happening internationally, and I'd like to ask Sean's opinion on this, is the change in regulation that we're seeing coming into Australia and coming into the UK in terms of the whole commission-based sales kind of argument. I think that's a critical sort of challenge for the industry. I mean, I'm seeing some very interesting trends in Europe where new products are coming onto the market where it allows the financial planner or advisor to actually have some control over the investment process, because then they can justify much more realistically charging a fee for that advice rather than just being a conduit for a product provider that they're selling on a commission-based argument. But what's your view on the South African scene?
On the South African scene, I mean, firstly, if you look at the regulators here in South Africa, they very, very much keep an eye on what's happening in Australia and UK specifically. So if it's happened in those countries,
it's happening next year.
It's going to start happening here. It's already started happening here. If you start having a look at the recurring premium investment space, the commission in that area has already been cut down quite dramatically. And I think if anything is going to be good for this industry, that is going to be it. They've got to separate the advice from actually selling that investment product, so to speak. And if you're going to advise a client, you must get paid a fee for that advice.
But will the IFAs be able to take responsibility then? Because if you're charging a fee, you need to obviously provide some kind of service, and then you're accountable to some extent. So I guess there are those that might not be comfortable with that, and there are those that have the systems or the infrastructure to actually make those decisions.
And I mean, that's in place for someone to use, or a planner to use right now. I mean, there's platforms at the moment where you can literally go and buy stocks within an endowment or retirement annuity type platform. So you definitely have that
Sean,
flexibility.
what about commission, IFAs being paid commission for certain products that are sold? And tell us about what your experience is and the relationship between the product, the person that is obviously you're buying the product from, to ultimately sell to the client. Clearly there must be relationships and synergies.
There are relationships. I think a lot of people, when they look and say, well, are you truly independent? Does that mean that the company is not paying you a commission? Every company pays a commission, and they're all on the same sliding scale. So that's not the independence argument. Okay. The key thing for me is to say, if I've done advice and planning for a client, they should pay a fee for that. I shouldn't have to go and justify spending time with their client by having to sell them an investment product. And I tell you, where I see it a lot is you're starting to see in the recurring premium space, specifically around retirement annuities, where they're getting churned all the time. And there's huge costs attached to that.
But do you find that some IFAs are pushing certain products because the IFAs get better commission for pushing those products?
Well, one, you don't get better commission. Number two, there's conflict of interest that has come in effective April. Right, which is basically taken all the different sort of bells and whistles that one could offer a financial advisor off the table. So everyone's on a pretty much level playing field as it stands right now. So no one's really encouraged or enticed to put product with a specific company for any reason. The only thing that comes in is perhaps service. And I know a lot of the IFAs say, what type of service will I get for my clients out of that company? And that forms part of the decision that one would make on when and where to put the money.
You see, I mean, I think IFAs are is a all catch area at this stage. If you're an individual and you need serious tax expertise, go find a tax lawyer. Go find a CA who's got serious tax expertise and they've understood problems and they've worked with SARS for many years. If you again have got a very complex estate, go find somebody that could potentially help you with that. But IFAs play a valuable role in where somebody comes to them with their financial affairs and they say to them, look, I don't have anything massively complicated, but help me understand this, because I don't know anything about markets. I don't understand how the stock market works. I don't understand how the bond market works. What is it that I need? And it's within that space that I think IFAs firstly need to charge for the work that they do, meaning charge a fee for the work that they do, and then by all means have some alternatives as far as implementation is concerned. And then once there's those alternatives, it's the client's wish to either implement with the IFA or not, should they not
And
wish
I'm
to
sure
do
that
so.
the clients also do their homework, and they also want to see historically if you've actually reached the targets that you've set for previous clients. Does that happen often?
Well, not really, because again, what you're doing is you're very much dependent on the asset managers that you're then working with to drive those types of returns. So no, when it comes to gauging or anything like that, no client has sat down and said, well, you know, how much of the asset manager that you have chosen have done for the clients.
Okay.
Every person's going to be very, very different, and it's going to be specific.
Okay.
As a matter of fact, sorry, can I just quickly make a point as well? I mean, I've seen it happen. I mean, it shouldn't happen, and Sean's quite right, but I've seen it happen, where specifically you sit in a situation where a client walks in and says, hey, the guy around the corner can give me 12, what can you give me? Okay, can you give me 20? Okay, and quite frankly, it's a function of markets, and that is often a discussion that you then start having with a client. You start right from ground zero. Because in essence, you've got to sit down, and you've got to sit down with the client, you've got to explain how markets work, how potentially different asset classes can work, the asset allocation decision, all the other stuff, which then, you know, becomes a completely different debate, I think.
Okay, we're wrapping this up. Roland, last thoughts from you. Been awfully quiet.
I think a lot of people need financial advice, and they need to find the right people out there and not do it themselves. Finding the right advisor obviously might require trial and error, and that's where it's a bit risky that you might end up with the wrong one, but do your homework first.
Should you not only not have one, perhaps 2 or 3 financial advisors that are advisable?
I don't know, Sean, you probably
a bit
better qualified to
Put your
say if
eggs
that's
in
a
one
good
basket?
idea.
I mean, essentially, that's what we're
Diversify
talking about.
across advisors.
Across advisors is very, very difficult. You know, it's kind of if I went to a golf coach and I had 3 different ones telling me to adjust my swing slightly differently, what am I going to get at the end? I think it's critical that you're going to sit with one person and take it from there, because you need to have an eye on what everything is how everything fits together, not just portions of it.
Fantastic. We're taking a very short break, and on the other side of this, we'll be getting into the Old Mutual Top Companies Fund. So we'll see you in just a bit.